Well, the rotation seemed to be in play in the markets again today. Value outperformed cheaper stocks, saw movement. Healthcare financials, those took the lead. Is the rebalancing a good sign for the rally? Joining us now is Carson Group Chief Market Strategist Ryan Dietrich and Wealth Enhancement Group Senior Portfolio Manager Ayako Yoshioka with $124.5 billion in assets under management. It's great to have you both here. Ryan, I'm going to kick this off with you because we do have a Dow that's just closed above 48,000 for the first time. I know you've been a bull for a while here. I assume that's going to continue for you. I am curious what you think of breadth and what you think of this rotation, especially as the government shutdown is about to end.
Well, first off, thanks for having me back, Morgan. Appreciate it. Today was the 1,615th all-time high ever for the Dow. So congrats to the bulls out there. I love this conversation about market breadth because we've been hearing nonstop for years. It's only 7 stocks. It's only this, only that. We would push back against that. Just last week, if you peel back the onion, more stocks in the S&P 500 were above their 20-day moving average at the end of the week than were at the start of the week. So far this week, we've seen more expansion above 20 days, more expansion above 50 days. Last week, 7 sectors were higher. 8 sectors outperformed the S&P 500. We get it. These large names kind of swing things, but I think this really hammers home why you want to keep a diversified portfolio, why you don't want to just go all in on Mag 7. Trust me, we manage, what was it, 100 and something billion? We manage about 7 billion. So, small peanuts, I guess. But with our $7 billion, we're looking at it like, you want to have a globally diversified portfolio. Last comment here. Look what Germany did today. Germany's soaring. You have European financial banks hitting all-time highs. Those are not things you see if the sky's about to fall, like so many people keep telling us all the time.
And I want to get your thoughts on this market. The S&P finished basically flat here, up 4 points, 68.50. We've been talking about valuations for quite some time and the fact that they look stretched historically. How much is that injecting volatility here? And I guess just how important is that for investors as we look to the end of the year in 2026?
Sure, Morgan. Thanks again for having me. So, when we look at markets, everybody knows it's a little expensive, right? It's trading at 23 times forward earnings. But when you dissect this, it's really the tech side that is the most expensive. And so when you look at, tech as a sector, it's trading at 11 times price to sales, which is really expensive. And that sort of explains why we're seeing this broadening of the market. And, there are other sectors that trade much cheaper, closer to 1 to 3 times, whether it's financials or industrials or healthcare. And I think that's why it really makes sense that we're seeing this broadening out in the market.
I do want to mention that Cisco results are out. The stock's up just over 4%. We'll bring you those just as soon as we've gone through them. Ryan, back to that question about not exactly market breadth, but sort of the impact of the influence of these really huge tech stocks. What happens if they stall? Is there really anywhere in the U.S. markets that you can imagine hiding that won't be affected, or do you have to go international?
Yeah, John, clearly we know tech adjacent is about half the U.S. stock market, right? We all know that. So clearly if it pulls back, you're going to have some issues. But that doesn't mean, you can go overweight international, right? We've liked developed international for a while. As we just said, there's lots of parts of the market that are cheap. But I'll tell you this much. What gets me, just on Friday, a New York op-ed piece says it's 1929 all over again. That Michigan consumer confidence, people are apparently the consumer is more worried now than during the great financial crisis or a 100-year pandemic, right? Expectations are so low. People get angry on the way up, then they panic on just normal 2 or 3%, volatility on the way down. To me, that's lowered expectations. And then you look what just happened this earnings season. We have a dovish Fed coming. There's still reasons to think this bull market is far from over, in our opinion, John.